When people think of China and the United States, they usually think of two completely different economic systems. But when it comes to taxing overseas wealth, the gap may be narrowing. China has launched one of its biggest tax enforcement drives in recent years, with authorities reportedly examining overseas investments, freezing bank accounts, and in some cases demanding taxes on gains made more than 25 years ago, according to a Financial Times report. So why is Beijing doing this now? The answer lies in China's slowing economy. Government revenues have come under pressure, while income from land sales, a key source of local government funding, has almost halved since 2021 because of the prolonged property downturn. As traditional sources of revenue weaken, Beijing is looking elsewhere. According to the report, banks and financial institutions have been asked to review overseas investments held by wealthy Chinese residents and check whether related income was properly declared to tax authorities. The assets under scrutiny reportedly include foreign property, stocks, cryptocurrencies, and offshore trusts. In some cases, officials are reviewing transactions dating back to 2000. Some banks have even frozen accounts until outstanding taxes and penalties are paid. Authorities are also taking a closer look at tax residency. Simply spending fewer than 183 days a year in China may no longer be enough to avoid Chinese taxes if officials determine that a person still qualifies as a Chinese tax resident. China is also tightening oversight of offshore trusts. New rules introduced last month mean income generated through many offshore trust structures can now attract a 20% tax, closing a route that many wealthy individuals had used to hold overseas assets. The US has long taxed its citizens and many residents on their worldwide income, regardless of where it is earned. Foreign investments, overseas bank accounts, and capital gains generally have to be reported, with taxes paid after claiming available credits and deductions. China's tax system remains different, but by stepping up enforcement of overseas assets and worldwide income, Beijing appears to be moving closer to a model of much tighter global tax oversight. The bigger story isn't just about collecting unpaid taxes. It's about China expanding its financial oversight beyond its borders and signaling that overseas wealth is no longer beyond the reach of its tax authorities. Follow Business Standard for more such stories.